we're gonna talk about asset allocation.
Right.
So, like, what are your thoughts on asset allocation? Like, how do you help clients to allocate assets and so forth?
So your typical categories is cash, bonds, stocks, gold, right? Your most common ones are these four categories, right? So, and then of course within each stock, each bond, then you have subcategories like what industries, government, corporate, etc. I believe in it, right? I think it adds value, but more importantly is your proportions would adjust according to the outlook, right? Okay. So it's not as easy as saying, hey, let's just do 25% of each, right? That's the laziest way of doing it.
Yeah.
If I knew that let's say for example last year when interest rates were increasing aggressively, I didn't have any bonds in my portfolio because interest rates and bond prices are inversely related.
So when interest rates go up, bonds go down.
Exactly.
Okay, do you want to explain why?
So for example, if you issued a bond today and it's at 3%, and it's worth $100, let's say, for example, then 3 months from now, interest rates have gone up. For the same bond that issued 3 months from now, because interest rates went up, I can get 4% on that, right? So all of a sudden, if I get 4% over there, your bond only offered me 3%, is no longer worth $100 to me because it's only giving me 3%. So why would I buy you?
Okay, so me, Gary Wong Group offers a company bond. I was like, hey, Joe, I need $100 from you. He gives me $100. Here's a $100 bond. I'll give you 3% in like a year or whatever.
Yeah.
And then 3 months later, Joe over there has like interest rates went up to like 4%. And then so he goes and gives you like a 4% return. So all of a sudden my bond is worth less.
Exactly. So that's why there's that inverse relationship with bonds. And so going back, so why I didn't have any bonds in the allocation last year is because interest rates were just increasing so aggressively that it didn't make sense for me to have bonds in the portfolio. So that's what I'm saying, depending on the outlook of
So if you see interest rates going down, which maybe not in the short term, but in the long term it's going to go down, then you might consider buying bonds.
Exactly.
Now, because you know they're going to go up.
Yeah.
Right. Oh, okay.
Yeah.
I see.
So that's what I'm saying. With the allocation, I believe in it, but you have to be adjusting it
like
based
pivoting.
on. Yeah, you have to, I had gold last year, seeing with inflation, and it worked out. So it really depends on.
Also gold, so my understanding of gold is that it hasn't gone up very much. Like if you compare gold 10 years ago, it's probably very similar. Why do a lot of people still invest in gold and silver and those kind of things?
For safety reasons, right?
Okay.
Because no matter what happens in the world, gold is still worth something. People still value gold at this very moment.
Yeah.
And silver. But again, would I always have gold in the portfolio? Probably not, because to what you just said is that, in the last 10 years, gold is pretty much here to here, it's been flat.
Yeah.
Right? In between, there's some ups and downs.
Is that better? Is gold better than cash then? But cash is you lose purchasing power, right? Because $100 10 years ago is different from $100 now.
Again, it depends on the situation, right? But so that's what I'm saying. Asset allocation is important, but we just need to know when to put into certain categories
and how much to put in certain categories.
Exactly. Like as I said before, we would never have way too much in cash.
Yeah.
Right? It wouldn't make sense.
Yeah.
But unless I knew or I saw the potential of a huge recession coming, then maybe I would just go safety and put more into cash or in gold. But if that wasn't the case, I would never have too much in cash.
Is there a difference with somebody investing in gold, silver versus cash?
With gold and silver, you're buying capital appreciation.
Okay.
You're hoping that it goes from 1,800 to 2,000.
Oh, okay, I see.
With cash, you can put into a savings account that generates maybe 3, 4, 5% a year.
Okay, like a term deposit.
Yeah, you could do that. But relatively speaking, the returns are lower than gold, bond, or stock.
Gold actually has a higher...
Potentially.
Oh, potentially.
Depending on, if it goes up.
Okay. But then in term deposit, it always goes up.
Well,
but stable.
every so slightly. So safety.
But it could be it could go up lower than inflation.
Exactly. It's a safety play.
Yeah.